Namaste, welcome to Arthaniti, where we discuss money and money matters to help you in your investing decisions. A second part of the series that we started yesterday, wherein we were discussing Trump's tariffs, the tariff pause, and why Trump took the action of pausing the tariffs suddenly. Today, in this second part, we will check what the status is on the US China trade relations, where do tariffs stand, and if the war further escalates, the tariff war, what is going to be the impact on US and China and a ripple effect on the rest of the world. So, let's start. The current status of tariffs that US has levied on China stands at 125%. Trump flipped once again yesterday, excluding smartphones, laptops, computers, processors, memory chips from imports from China. Chinese government on its part has also levied a 125% tariff effective 12th of April on all imports from the US. How is this going to impact China and the US? Well, we'll take a look at China first. Now, escalating tariffs possess a serious challenge for the export dependent economy of China. Goldman Sachs projects that Trump's latest tariffs could decrease China's GDP by as much as 2.4%, reducing growth to around 4.5% in 2025. This is below the Chinese government target of 5% growth. Some analysts are even more pessimistic, with UBS suggesting growth could fall to just 4% if the tariffs remain in place. As of 2024, of the total Chinese exports, 14.7% went to the US. Now, this is down from nearly 19.2% in 2018. This reflects China's efforts to diversify its trading partners. Now, China's recourse if US exports decline further is diversification, wherein it is expanding exports to Southeast Asia, Africa, Belt and Road Initiative countries. Domestic consumption push is also on the cards in China. Beijing is prioritizing self reliance in critical sectors like food and rare earth minerals. China has also imposed retaliatory tariffs on US agriculture and restricted exports of graphite, a key material in batteries. The Chinese government has taken a defiant stance, stating that at current tariff levels, there is effectively no market for US imports in China, and warning that should the US government continue to escalate tariffs, Beijing will choose to disregard them and fight till the end. What is going to be the impact on the US economy? Well, the US economy also faces significant risks from this trade war. Higher tariffs typically result in increased prices for American consumers and businesses. The universal 10% tariff, along with specific higher rates on certain goods, will put inflationary pressures on the US economy. According to Bloomberg Economics, even with partial pause, the average tariff on all US imports is estimated at 24%, the highest level in a century. Additionally, the US is facing retaliation not just from China but potentially from other trading partners if negotiations during the 90-day pause don't yield results. Is Trump's Make in America push feasible? Well, Tim Cook, the CEO of Apple, in one of his addresses, warns of the skill gap. He emphasized that the US lacks vocational training for large scale manufacturing. For example, China has multiple football fields worth of tooling engineers, while the US struggles to fill a single room. Now, this was his views expressed in one of his interviews. The US faces a deficit of 4 million manufacturing jobs, with only 13% of engineering interested students completing degrees. That is a vast gap to fill. Now, what are going to be the global economic implications of this escalation of trade war between US and China? Well, US and China combined represent approximately 43% of the global trade in 2025. A slowdown in both these economic giants will inevitably ripple throughout the global economy. The uncertainty created by these rapid policy changes and potential further escalations has already dampened business confidence. Economists warn that this uncertainty may further weaken the global economy by stalling corporate investment decisions. Supply chains that have been carefully constructed over decades are now being forced to reorganize quickly, creating disruptions and inefficiencies throughout the global trading system. Sitting in India, what interests us is how these global moves are going to impact India's economy. Well, India's merchandise export to the US are projected to decrease by approximately $5.76 billion dollars in 2025, falling to nearly $84 billion. Dollars. Now, this represents a decline of 6.45% compared to 2024 exports, which reached at $89.81 billion dollars. Some sectors are projected to hit particularly badly. Which are those? Well, fish and crustaceans could see a 20% dip. Iron and steel products may fall by 18%. Diamond, gold, and related goods can decline by 15.3%. Vehicle and auto part export will decline by almost 12.1%. Electrical, telecom, and electronic items are projected to see a 12% reduction. However, some sectors may actually benefit due to competitive advantages, including textiles, apparels, ceramic items, inorganic chemicals, and pharmaceuticals. The new US tariff policy is projected to reduce India's export to the US by approximately 30 to 33 billion dollars in total. Now, this will potentially contract India's GDP by zero point 0.8 to 0.9%. This is significant but manageable within India's broader growth story. Despite these disruptions, India is still expected to achieve a projected growth rate in GDP of 6.3% to 6.8% for financial year 2025-26. RBI, on its part, has reduced the projections from 6.7 to 6.5. This resilience reflects India's relatively diverse economy and ongoing domestic growth drivers. What has been India's response and strategy for US tariffs? Well, unlike China, which immediately retaliated with counter tariffs, India has taken a more cautious approach focused on negotiations and bilateral trade talks. According to Trump's trade representative, India is among several nations that have expressed willingness to discuss both tariff and non tariff barriers under Trump's push for reciprocity in trade. The Reserve Bank of India has also responded by cutting interest rates by 25 basis points to 6% to stimulate domestic consumption and offset potential export losses. India is actively pursuing trade diversification through several strategies. Firstly, by expanding the FTA network, free trade agreements. Now, India is finalizing or negotiating free trade agreements with the EU, UK, and partners in the Middle East, Africa, and Latin America, as well as the US. Strengthening regional partnerships is also on the cards. India is deepening ties with ASEAN countries, Australia, New Zealand to reduce dependency on solely the US markets. Programs like Make in India aim to strengthen local production capacity, particularly in electronics, semiconductors, and automobiles. With companies looking to reduce dependence on China, India is positioning itself as a China plus one alternative manufacturing hub. The US China trade war, while disruptive, potentially creates opportunities for India. What opportunities are potentially to the benefit of India? Firstly, the EU nations are seeking reliable trading partners as alternatives to both US and China. India could fill this gap by enhancing export competitiveness. Sectors like garments, textiles, toys offer particular potential, especially for India's MSMEs seeking to capture market share from Chinese exports facing high tariffs. The slowdown in China's growth might accelerate China plus one strategy many multinational companies are adopting, potentially benefiting India as an alternative manufacturing hub. Will Trump's plan work of shifting the manufacturing back to the US? Well, in the short term, it seems unlikely. The US lacks skilled workforce and infrastructure to replace China's manufacturing scale and capacity. In the long term, maybe. If paired with vocational training and subsidies, the US could rebuild capacity. However, automation and high costs will remain barriers. To conclude, during this 90-day pause period, what should Indian investors expect and how should they strategize? Firstly, expect continued volatility in the global markets as trade tensions evolve. Secondly, watch for sector specific impacts. Some sectors in India will face headwinds, while some sectors may find new opportunities. Thirdly, India's overall economic trajectory remains positive despite external challenges, with domestic consumption and investment continuing to drive growth. Fourth, government policies, including interest rate cuts and trade agreements, will play a crucial role in mitigating negative impacts of US tariff. Fifthly, the coming months will be critical as the pause period will end in July 2025, potentially leading to either resolution or further escalation. Remember, in times of volatility, diversification is your all weather friend. Seeking expert advice will help you take the right investing decisions. I hope this video has given you a perspective of where world tariff war stands and what global trade and its headwinds or opportunities for India we as investors should expect. If you have liked this video, please like, share, and subscribe to our channel for more such informative content. Until next time, stay safe and happy investing.